Welcome back to Quant Forge. On this channel, we test trading strategies with real data, real Python code, and real backtests, so we can separate ideas that sound smart from ideas that actually work. No Lamborghinis, no bullshit. Last time, RSI got completely destroyed by buy and hold. So today we're testing something a little more advanced, the MACD strategy. MACD stands for Moving Average Convergence Divergence. Yeah, traders really need better naming conventions. The strategy itself is still pretty simple. We buy Bitcoin whenever the MACD line crosses above the signal line, and we sell whenever it crosses below. That's it. No leverage, no prediction models, no AI generated 1,000 times secret strategy, just trend following using moving averages. We start with $10,000 and test the strategy on Bitcoin data going back to 2019. First, we download the historical Bitcoin price data directly from Yahoo Finance. Then we calculate the MACD indicator itself. The blue line is the MACD. The orange line is the signal line. And the idea is simple. When the blue line crosses above the orange line, momentum may be turning bullish. When it crosses below, momentum may be weakening, at least in theory. Next, we generate the actual buy and sell signals automatically using Python. And honestly, this already looks way more active than RSI. The strategy is constantly jumping in and out of the market trying to capture trends, which means one of two things is about to happen. Either the strategy becomes a genius trend following machine, or it gets completely chopped to pieces. So now it's time for the real test. We run the full back test and compare the MACD strategy directly against simply buying and holding Bitcoin. And this result is actually very interesting. Unlike RSI, MACD didn't completely collapse against buy and hold. And in fact, the strategy performed surprisingly well. $10,000 grew to roughly $124,000. Meanwhile, buy and hold still finished higher at around $210,000. So buy and hold still wins, but not by nearly as much as with RSI. And here's the really important part. Look at the drawdowns. Buy and hold suffered a brutal maximum drawdown of roughly minus 77%. Meanwhile, the MACD strategy reduced that to around minus 51%. That is a massive difference psychologically, because surviving a 77% crash without panic selling is not exactly easy. Now, of course, there's a catch. MACD generated way more trades than RSI. And more trades means more fees, more whipsaws, and more opportunities to get destroyed in sideways markets, which explains why the strategy struggled during choppy periods. Next, we optimize the MACD settings. Instead of the default 12, 26, and 9 setup, we tested multiple combinations automatically, and the best performing version actually used 16, 20, and 12. That version pushed the final portfolio value to roughly $266,000, which is actually higher than buy and hold. Now, before everybody loses their mind in the comments, this is where optimization becomes dangerous, because once you start searching through parameter combinations, it becomes very easy to accidentally overfit historical data. In other words, the strategy may not have discovered a real edge. It may have simply discovered the past. And unfortunately, the market does not care about your backtest. Still, compared to RSI, MACD clearly behaved much better. It captured large trends reasonably well, reduced drawdowns significantly, and stayed competitive with buy and hold for long periods of time. So overall, this was probably the first strategy on the channel that actually looked somewhat respectable. Anyway, this is exactly what we do here on Quant Forge. We test trading ideas objectively and let the data decide what survives. Next time, we'll test another popular trading strategy to see if it performs any better.